Hey, this is Sasha, and welcome to another episode on Hungry for Returns, where I share with you questions and answers from our viewers. And if you have a question that you want answered on video, then be sure to take a look at our website, tradersfly.com, where you can submit a question by writing one in or even by voice. Now, today's question was written in, and we're going to take a look at some fundamentals. So let's take a look here on screen, and I'll go ahead and read it to you. Basically, what is the most important thing to watch with fundamentals? So I know there are a lot of things out there when it comes to fundamentals, so it gets pretty confusing. What is the most important thing to watch when it comes to fundamentals? Do I need to dig deep into the financials and the reports, or what should I do with all these company financials, Carl? Okay, so I get a handful of these questions coming in. We focus a lot on technicals. So for me, I focus quite a bit on technicals. And one of the reasons I do that is because stocks typically move based on technicals. There are fundamentals out there. So there's a lot of things you can dig deeper into the fundamentals. Here's one on McDonald's that we'll talk about here in a second. But typically when stocks have great charts, they will have great fundamentals. And when you have great fundamentals, you typically have great stock charts. So they work hand in hand. However, when there's panic, when there's all heck breaks loose, when you have stocks moving in a euphoria fashion, like really happy mood, it's because of the technicals, not so much of the fundamentals, at least not the core fundamentals, okay? Usually fundamentals are slow to move. So if you look at company financials, these companies are huge. So for them to make a change or shift, let's say, hey, we're gonna go from paper menus to LCD menus, that's a big change and it's a big investment, and let's say they got millions of locations, so it's going to take a long time to do that. So by the time they implement this, it takes a couple of years to really make some changes. So when you look at fundamentals, what you really are looking for is a long-term projection if you're a long-term investor for, let's say, 5+ years. Usually 3+ years is good, but 5+ years is nice. So when you look at these things, when you look at McDonald's, the number one thing to really watch is earnings. And earnings are key because they're either making money or they're not making money. A lot of times companies can fudge their earnings a little bit. So if you look for companies that are beating by 5%, 7%, what they can do, the way that they fudge these numbers is they pre-ship things in advance. They'll pre-ship products in advance. Sometimes what they'll do is they'll cut employees. They'll go ahead and fire people, and this is naturally a good thing for stocks because the company saves money. Obviously, it's not good for the regular person, but for stocks, they love it because, oh, okay, we can do the same amount and make the same amount of money, but we have less expenses, so we can fire 10% of our workforce. Great. You know, obviously the other people that are getting fired, they don't like that. But this is what a company, what you're looking for is you're looking for 20+%. That's a real growth company. If you're looking for stability, 5-10% earnings growth is nice. Now, when you look at these percentages, here's a forecast earnings growth in McDonald's, and I just pulled this up on NASDAQ. You could type in any ticker symbol in here that you want. You just look it up and you go to the company growth, analyst research forecast growth, or you can even go ahead and change one of these symbols, and let's just say we go to Clorox right here, Colgate-Palmolive actually, and you can see here's the growth, forecasted growth. Now, for me personally, I like Yahoo Finance better for this. Yahoo Finance actually does a really good job with a lot of fundamentals and a lot of stocks and a lot of just finance overall. So if you go to Yahoo Finance and just go start from the beginning, here's Yahoo Finance. We'll type in McDonald's here on Yahoo Finance. And when you look at it, here is your overall stock. Okay. Now, what you can do is take a look here at the financials. So on the right, they'll have kind of financials, annual and quarterly. And you can see just really on the earnings, you can see how the earnings are naturally here growing, right? So you can take a look at the blue line there. So they'll give you kind of an estimate. They'll give you kind of the actual earnings reports, and you want to see those continue to grow. Now, you could go ahead and click this, and this is an interesting part. If you want to dig deeper into it and you're more into the financial reports, you could go ahead and do this, but the reality is it's tough to really understand these things at a regular consumer level. And that's because they bury things also in different accounts. And, as you're doing taxes and paperwork, it's just, everything is just in so many different compartments, especially with these big companies, that really to understand the company, hey, what's the income? What's the continued operating expenses? What's the recurring events, recurring income, net income? That's the bottom line. I mean, that's why, to simplify things, if you just look at earnings, that tells it all to you. And as I mentioned before, if you're just looking at earnings that are, making a 5% kind of beat on earnings, it's not a huge growth company. Now, that doesn't mean you want always mega growth companies, but typically 10, 15% earnings growth year after year from the same quarter, right? You have to compare January to January of the previous year, not of the January to April, because if you compare that, you're in different seasons. So you have to compare January to January of the previous year, and you want that to continue to beat in growth. Otherwise, if you want to dig deep into the balance sheets and income statements, you could do that. Hey, okay, revenue. What's the revenue? Okay, 21,000 million, 21 million. And again, this is probably in billions or something like that. And then you go ahead and take a look at the loss or operating income or loss. So again, then they're spending 8.5, and then from continued operations, it's 5.9. So between those numbers, 10.7, you got 8.5, 5.9, and then net income 5.924, and that's where you get your kind of final number. So as you can see, how do you decipher this as a regular human being? Unless you're an accountant, it makes it real tough. Because, okay, what do you really want to know? Well, if you want to really dig into it, well, how many hamburgers did you sell? How many soft drinks did you sell? Well, in here, it's not going to really tell you that, right? If you look at Apple's statement, let's take a look at Apple right here, because we know they sell phones and tablets. Well, again, you start looking at this, oh, where are the phones? Where's the MacBooks? Where's all these devices? And again, you can't see this. Let's go to the balance sheet. Again, okay, we take a look. Okay, we look at nets, receivables, this and that. Again, not very helpful, right? So what's interesting about this is when you look at these companies that make a lot of money from a single product, let's take a look at Apple. If you listen to the earnings call, right, and you're listening to one of these guys talk about what they're doing and how the sales are of the iPhone, if you hear the sales of the iPhones are slipping, that's not a good thing. And you're not going to be able to see this from here. It doesn't say iPhone sales. There's nothing in here that says on the balance sheet iPhone sales, right? Look at it. So what you want to do is start looking at these things at a bigger picture and a bigger, deeper level on a product-to-product basis if you want to dig deeper into it. If you want to keep it simple, if you just want it simple, all you got to do is look at earnings. And you look at here, you could do quarterly earnings, you could do annual earnings, and you just want to see it continue to grow. And that's really what you want to see time after time. So let's just take a look at Apple earnings history. So we'll type it in and boom, go to NASDAQ. And now you can see, okay, well, earnings per share, consensus, estimate. So you can see, boom, 2.73 was in 2018 of March 2018. And consensus forecast was 2.69. Okay, so they beat it. Right, so here in June 2018, you can see the EPS forecast was 2.17. They went 2.34. So, okay, so they're continuing to grow and beat their earnings. And that's really what you're looking at. Okay, are they beating their earnings? And then you also look at, okay, well, what am I also looking for when it comes to earnings growth? Okay, so earnings growth, what are we looking at? Okay, well, by September 2021, it's expected to be about this number. Okay, 2.42. September 2020, we're at 11.68. Does that really tell you much? Well, no, because things could be in development. They could continue to do new inventions and greater things. So that's why if you look at earnings per share and the numbers keep going up, right? If we look at McDonald's and we look at the financials. Let's look at here the Yahoo Finance McDonald's earnings history. Let me see where it popped me in here. So here's the summary and earnings here on the right. There we go. So here's the earnings estimate. You can see current quarter, March 2019, next quarter, and the current year. So it kind of tells you number of analysts here. Average estimate is 1.81. Next quarter is 2.07. Current year total, right, 8.17. Low estimates 1.75. So high estimate year ago is 1.79. So here's the history. So if you look at the history, okay, here we have estimate versus the actual. Okay, so the estimate 1.67, the actual is 1.79. That's good. Estimate 1.92, actual 1.99. It beat it again. Estimate 1.99, actual 2.1. Good. Now you take this, right, and compare it to the previous year, and you go back in time. So you continue to do that and evaluate these things and pull up the history of these things. So that way you can start comparing, and as long as they keep moving up, you can see, then that's a good thing. Otherwise, as far as fundamentals go, I wouldn't stress too much on revenue, research, development, these kinds of things. Look at the main products, like an Apple business or a Netflix business. What's their main couple of products? Where are they generating income from? And if those are doing good, Apple, where does it get its revenue from? Stock, let's look it up. Let's see if it'll give me kind of a breakdown. I know it does that on Thinkorswim, but just wondering if there was a free website for you to breakdown of product sales in Apple. Oh, here we go. So let's take a look here. Share product category. Okay, so product category, this is really what you want to look. Okay, look, they're making the majority of their income 50% from iPhone. Well, imagine if that iPhone starts having problems, that's going to have a lot of issues. So that's really what you're trying to evaluate on these companies. And same here, look at 2019, 61% is coming in from the iPhone, and only 8% from the iPad. So if they say, hey, we got a new iPad coming, or new wearables, 8% from that, it's not that exciting, right? Unless it's a huge revolutionary thing. But in this case, look at their core product lineup. Where are they making their money? How's it doing? Is it continue to grow and improve? And if it does, that's good news. If it doesn't, well, that could be a problem. So anyways, that's what you want to do when it comes to fundamental analysis and really just evaluating things. You don't have to make it that complicated. I don't really dig deep into these reports. It's a lot of time that you have to spend, and a lot of these companies, they're slow moving. Just think about it, how difficult it is to make changes to big corporations. They're slow moving. If something's been going on the last year or two, chances are it's still going on. Look at Wells Fargo. When they had their scandals, they had more scandals that came out a few years later. No surprise. That's no surprise at all. And that's the same that goes with anything that you're evaluating. If earnings continue to beat over the last year or two, chances are they'll continue to beat over the next few years as well. So when you're looking at choosing a company or a stock to invest in, and you're looking for it based on fundamentals, you're usually doing it because of the long term. You're not doing it for a short quickie. If you're doing it for a quickie, you want to look at technicals because those move more on a rapid basis. But here, for the long term, look at earnings. You don't have to dig that deep into the financials because you'll probably get confused anyway. Even the accountants don't even understand all of those things because you have to look at where the product's really coming in. So unless you have full access to their books, it's really difficult, right? Other than that, I would say look at those earnings reports and make sure that they're beating quarter after quarter and from quarter of the previous year. And when you do that, and if everything looks okay, even then they might have a fluke here and there. But if it all looks okay, then it should be a good company. And if it was a good company over the last 10 years and it continues to grow, then it'll probably be another good company still for the next 10 years. So that's my thoughts on looking at these fundamentals. Of course, you could dig deeper into it. You could get really into it, but is it worth the time? It's up to you. You have to decide, because you have to put your money to work. For me, I think just looking at it from a base level, you should be able to make a logical, healthy decision in a stock just based on general knowledge and looking at the charts for the longer term to seeing how these stocks have been performing over the last 5 or 10 years. And if they've been doing well, then they should continue to do well. So thank you so much for joining me in this week's episode. Hope you found it helpful, insightful, and you learned a little bit of something about fundamentals and where to get some of these studies. But again, I wouldn't stress too much about it, because most of the good companies you probably already have in the back of your head of what you want to invest in, and go with it a little bit at a time, continue adding to it over the next 5 or 10 years, and you should be fine. If you struggle with that with a single company, then just look at an ETF, diversified ETF, and you'll be much better off. All right, thanks for joining me, and I'll see you next time.